hello and welcome to the MF Guide, your fund, your returns. I'm Hiral Desai. On today's episode, we are going to put the spotlight on contra funds and discuss if this is the right time to do so. Joining me on the show today are Tahir Badshah, Chief Investment Officer at Invesco India Mutual Fund, and Hemant Rustagi, CEO at Wiseinvest Advisors. But let's first quickly understand what contra funds are. Shivangani Mishra is here to explain the concept. Shivangani.
Thank you, Hiral. We know fund managers do what retail investors can't. And here's a category whose job is to move against the herd. For example, recently when investors were moving away from controversial stocks like ICICI Bank, leading it to fall by 11% in March, funds like Invesco India Contra Fund added over 1 lakh shares of ICICI Bank to their portfolio. So simply put, a contra fund is a category where fund managers take contrarian calls on their investment strategies. Here they identify stocks with cheap valuations and ones that are underperformers in the current market. The hope is these stocks will outperform over a longer period. Sectors like IT, telecom, healthcare, etc., which were not as popular in the past, are doing well now. These can be considered as contra bets. Over the last 1 year, S&P BSE IT TRI index posted 42% returns, while S&P Telecom TRI gave 2% returns. The last 1 year and 5 year period contra funds gave 20% and 30% returns respectively. So clearly, even though these funds seem risky now, they post good returns over the long run. Back to you, Hiral.
Thanks, Shivangani, for just getting us a breakdown in terms of what contra funds actually are. But let's quickly welcome in Tahir Badshah, Chief Investment Officer at Invesco India MF, and Hemant Rustagi, CEO at Wiseinvest Advisors. Welcome to the show, gentlemen. To start off with, Tahir, I'll come to you on this one. In terms of where contra funds are concerned, overall, if you could just help us understand, when do you think they could actually become attractive investment opportunities?
So, the way we always advise clients who are looking at our contra fund is that this fund typically needs about 3-4 years of minimum investment horizon. We are essentially here talking about buying into companies which are today probably headwinded. They are facing maybe certain stress in their business, or probably in the sector itself in which they are operating are facing a certain amount of stress. Maybe they are going through a period of where growth has probably come down from what their average growth levels have been in the past. So essentially you're talking about companies who are not currently the most favored plays in the market, and we are talking about possibility of an eventual recovery a few years down the line. We are basically talking here about selecting stocks which we think are in a way leaders in their respective lines of business, but are currently going through a situation of underperformance and stress in their respective business. So these are the kind of companies essentially which we look at. We are basically focused on companies which are in either turnaround situations, or probably they are deep value, or maybe there we see a mean reversion of earnings. And these things generally take a period of 3 or 4 years for it to kind of fructify. But the good news is that in many of these names you get stocks which are relatively cheap. They are undervalued by the market, and generally it is about buying things which are probably, in our view, probably worth let's say 100 rupees, but probably the market is currently, the valuation in the market is maybe 60-70 rupees, and you are essentially playing for that, for the market to probably recognize the value over a period of time. What typically happens is that what is currently trading at 50-60 rupees doesn't necessarily stop at 100. It goes to 120, 150, maybe even 200. So the pendulum actually swings from one end to the other, and that is what we try to capture in this portfolio, and which basically means that over a reasonably good period of time you can end up with substantially higher returns than that of the market.
Right. Tahir, I would want to take a follow-up question on this one. Overall, if I see in terms of the returns of Invesco India Contra Fund is concerned, clearly across parameters, if I have to check 1 year, 3 years, 5 years, 10 years, or since inception performance, the Invesco India Contra Fund has clearly outperformed benchmarks in terms of S&P BSE 500 as well. Now, with everything said and done, in terms of the top stock bets, you have HDFC Bank, HDFC, RIL, Infosys, as well as ICICI Bank as well, where you have exposure to. Is it that, I mean, when is it that you take a call in terms of the churn in terms of stocks? Is it that enter at lower valuations in terms of where a contra fund goes, and you look at exiting, you know, once they hit their peak, and immediately a churn in terms of stocks happen?
Yeah, so that's a good question. So like as I said, you know, we essentially, the starting point for any new ideas which come into this portfolio is that they need to be undervalued. They need to be in a situation where they are not among the most favored stocks in the market, and they are probably going through stress in their respective line of business. So that's typically the starting point, and that is when we buy into these companies. So necessarily when things, when a new idea comes into the contra portfolio, it has to be cheap and undervalued. How long does it stay in the portfolio? It stays on in the portfolio till the time it remains growth at reasonable price. Sometimes it might probably, you know, something which is undervalued might become fairly valued, and you may not see any growth characteristics in that company. So you would exit that stock, or you would churn out that stock at that point in time. It might take 1 year, 2 years, depending upon how the triggers materialize for that name. Many a times, and that's what happens in a market like India, some of these undervalued names and stressed names go through a phase when they start, demonstrating growth once again in their respective business. And so we stay on into these companies in order to play the growth as well. We continue with these companies till the time they are, let's say, growth at reasonable price. As and when these companies get to a situation which in our opinion is growth at unreasonable price, or they get overvalued, that is the time when we would exit these names from the portfolio. So typically the contra fund therefore starts with undervaluation and generally tends to end at overvaluation. And as a result, in doing this, we ensure that we never pay a lot of money, or pay a lot of value, or overpay for these names at any point in time. Stocks continue to remain in the portfolio till the time they are cheap or reasonable, and as and when the stocks become expensive, the contra fund has a very low tolerance for high valuations, and that is the time when it would exit out of these stocks. So this is typically the cycle of ownership of any particular stock in the contra fund.
Right. Thank you for helping us understand that. In fact, let me welcome in Hemant as well. Hemant, if you could just help us understand what is your view in terms of where a contra fund is concerned. Vis-a-vis, you have the other, fixed income funds, equity, balanced. What is your opinion about a contra fund?
Well, my view is that there is definitely a place for contra fund in any investor's portfolio. Anyone who's looking at building a long-term portfolio. The problem is most of the investors, focus on growth funds, in the sense which are basically focusing on growth stocks, because that's where you can see immediate result. What happens in a contra fund is, because you're taking a contrarian bet, it can take slightly longer for those bets to actually kind of start giving results. So there can be, more volatility in the interim period. So as long as investors can live with that, as long as investors can live with the fact that one of the fund in the portfolio may not perform in line with the market, but in the long run it has the potential to do much better than other funds, I believe that there is definitely a place for a contra fund to be the core of equity portfolio. Unfortunately, what happened in contra funds are not very popular because either investors don't really understand, or you don't have too many contra funds which are true to label. So you'll see a lot of contra fund, but actually not looking at always contrarian bets, so to say. So I think that's one of the reasons why you have not seen contra fund becoming very popular. But I believe that if you really want to improve your overall portfolio return from equity, and at the same time you want some protection when the markets turn volatile, because these are, stocks or sector which are out of focus from the market. So they may not really fall the way the other growth stocks or growth sectors will fall. So clearly it will protect you in terms of when the market turns volatile. In the long run, like I said, if you can have a slightly longer view compared to a normal equity fund, these funds have the potential to do much better. So I think every investor who is looking at building a long-term portfolio should have some exposure to contra funds.
Right. So do you think investors probably then need to have more patience, with a pure play contrarian fund in terms of a longer time horizon then?
Oh, absolutely. Absolutely. Because, you're taking a contrarian bet. So if the fund manager feels that this will kind of, fructify in the next 1 or 2 years, it may take slightly longer period. As Tahir said very clearly, you should have at least, time horizon of at least 3 years. What we recommend to people is you're investing in equity fund to achieve your long-term goals, especially when you're focusing on achieving your long-term goals for building corpus for your child education, your marriage, or for kind of retirement. You have long time, so you can definitely wait. You can ignore the volatility which comes during the interim period.
Right.
So as long as you can do that, I think contra fund can be a great addition to the portfolio.
So then, if that's the case in terms of where contra funds are concerned, why aren't a lot of funds really launching any contra funds? Because right now I think there are just two. One is Invesco and one is SBI, where they actually have contra funds. Why aren't any other funds coming out or launching any new products in context to contra funds?
Well, clearly, like I said, I mean, the fund has to feel comfortable about the contrarian strategy per se. The fund manager should have the ability to be able to pick the right stock or the right sector, because I believe that in the contrarian fund, it's a sector which really matters a lot more than the company. For example, like we just mentioned about IT sector. Okay, nobody was being beaten down, but the fact is in the last 6-7 months or 1 year, it has given fantastic returns. So I think it again depends on. There are many funds who have value funds. Okay, sometimes investors really confuse value fund with the contra fund, but they're slightly different from each other. So maybe that's the reason why, if the funds are not very comfortable with their ability to, take the contrarian bet, you don't see another. I think another important issue is because the funds are not very popular. Most of the investors focus on growth funds.
Correct.
That's the reason you don't see too many contra funds in the market.
Right. Tahir, coming to you as well, the quantum of contra funds is less. And in context to that, investors going ahead and investing in, contra funds by mutual funds is also slightly lower as compared to their exposure in terms of, say, diversified or any equity, or, if you talk about a balanced fund. But taking all of this into consideration, if you could just help us understand, do you think it is a good time to adopt a contrarian approach right now with the markets at new highs?
The thing is that while the market is at a new high and markets have been really very strong for the last couple of years, even in the last few years, given the economic situation that we've had, it's not a red-hot economy that we are dealing with right now. Unlike in, let's say, if I were to contrast it with, let's say, 2008, when we had a situation where every sector was doing well at the ground, is what I mean, in terms of be it real estate or be it pharma or even consumer goods or whatever else, even IT for that matter. Everything was firing. Right now we are not in that kind of a situation at all. Even though the markets are at a new high and very strong, we have probably 3 or 4 sectors in the market, in the economy, which are doing well. There are 5-6 others which are not doing well. Okay, so there is a good amount of dichotomy and dispersion in the performance of businesses in the economy itself. And to that extent, even at 11,000 of the Nifty, we find a fairly decent amount of opportunities which are contra, which are not performed, which are overlooked by investors, which have turned value, which are in distress, and they fit into our theme. So Hemant mentioned about sector rotation, etc. Actually, I would differ here a little bit and say that over the last at least a couple of years, we have not found as many sector opportunities bottom up. There have been, let's say, IT, for example, which we played very well in our contra fund last 1 year, which you mentioned. But we have found a lot of stock opportunities within sectors. So there is a lot of dispersion within sectors where few stocks have been doing well and few have not been doing well. There have been examples of autos, there have been examples of banks, there have been examples of NBFCs and several others where we found this situation. So we have exploited a lot more bottom-up opportunities in the recent past, but given that this fund has had a 10-year track record, in the last 10 years, there has been a good number of times when we would have seen a lot of sector rotation as well. And I would therefore like to believe that it's not about the absolute level of the market today. Generally, under most market conditions, 2008 was a really typically different, very unique kind of situation. But by and large, we generally have situations where some sectors are doing well, some are not doing well. So there is always contra opportunities to be found in the market. There are always times when investors have overlooked a few things.
Right. So Tahir, apart from the exposure that you have currently in terms of a couple of stocks on the contra fund right now, any other stocks that could be good contra bets at these at current levels?
I don't know whether I'm kind of, I'm a little, I don't know whether I can talk individual stocks at this stage. Whatever is there in the portfolio today that you see is, in our view, what we think are contra opportunities at this stage, or they are maybe growth at reasonable price. What I would like you to focus on in the contra fund is not as much of the top weights, but look at our top overweights in the portfolio. And if you look at the companies that we are significantly overweight vis-a-vis the underlying benchmark, we have, if you look at our top 10 overweights, we have got an exposure of close to about 30% in those names. And those names in the benchmark are barely about 5%. So actually we are owning close to about a 25% overweight position in these 10 names. And these are the names which in our view are going to be the ones which we think will generate alpha for us in the portfolio going forward. And if these perform, then as you know, we will have a significantly better outcome compared to the underlying benchmark. So I would recommend and strongly urge investors to look at those stocks which are large overweight positions vis-a-vis the benchmark. And if you look at those top 10 names, you will find quite a number of them are not necessarily the most happening stocks in the market. They are not currently the most, the darling stocks of the market, so to speak. They are probably companies which have gone through a little bit of stress. They are compressed on valuations. Either growth has come off significantly, or maybe they have, or valuations have substantially eroded. So I think that is where the contra, feature of the fund essentially lies, and that is what we intend to capture going forward.
Thanks, Tahir, for sharing that. But Hemant, coming to you as well, I already mentioned the stocks that Invesco has, exposure to. But if I talk from a perspective in terms of the other one, which is SBI, their focus is probably 13.5% towards banks, 8.5% towards telecom, 7.5% towards engineering, 6.5% towards pharma, with exposure to companies like Bharti Airtel, Indigo, Cognizant, ICICI Bank, as well as LG Equipments. What is your view, and what would your recommendation be between an Invesco contra fund versus a SBI contra fund?
I think if I look at two factors, one is consistent performance. I think I would certainly go with the Invesco contra. Again, as an advisor, we look at the portfolio, whether what we see in the portfolio, we agree with that or we don't agree with that in terms of the future potential of the sector or the opportunities that are going to be there. Now, for example, if the fund has exposure to pharma, and we know that pharma is going to take a little longer for it to realize its potential. So clearly, for us also, it's very important to look at the composition of the portfolio. I mean, a couple of things that for this fund, for example, I've seen, like the fund took bet in Reliance at the right time, and the last 1 year, the Reliance has given on 39%. So clearly, we would go with the bets that have been taken and overall portfolio composition as to how the funds are done. So clearly, at this stage, my bet would be Invesco contra, then Magnum contra.
Right. So currently, Invesco contra versus SBI contra is the recommendation coming in there as well. But before we move ahead, let's quickly head across to a breaking